this one time, me and Carps went into this estate agency, right? It looks very done up, very nice, like typical. It's got marble inside and everything. It's obviously they're Iranian. So we go inside to discuss some potential deals with them. This is a few years ago. And the guy instantly clocks that we're Iranian. And this is not the boss. This is like his right-hand man. So he storms out the back in his extra baggy t-shirt tucked into his bootcut trousers, and he storms in with a Conor McGregor walk. And he says, cash دارین? Cash? Which basically means, do you have cash? Literally translating to, the guy expects you to walk into his estate agency with like, I don't know, 700 grand cash, because no one takes out mortgages these days. And he doesn't understand the concept of leverage to your advantage. He's like, cash done, cash. And he's basically trying to like put us down, like, you're not shit, you don't have cash. Anyway, let's get into things. Someone actually I met recently, not recently, a while back, I was talking to, after a few meetings or whatever, this person said to me, this Rational VC logo you guys have, the cover photo, which we'll pull up on the screen now, it's just our pod logo, right? It's just your face, my face, our headshots, and it says Rational VC. They said in this photo, which are the photos we have on our website, you, as in me, you, Cyrus, you come across, you're kind of like, it's deceitful, because your eyes are very soft in this photo. Your face is very calm. It looks very friendly and soft. And obviously, Iman looks like the one who's a bit more like, he'll bust your balls or something, And in real life, or when you listen to the podcast, it seems that it's the exact opposite. So don't fucking judge a book by its cover. I am the ball-busting, unapologetic.
I don't know if I should take that as a compliment or not.
If someone wants to, get a decision past Rational, which I probably wouldn't approve of, there may be a chance that Iman would approve of. Like, let's say you want to bring your guest on, or someone wants to bring a founder on, because we only do founders by invitation only. If they come to me, I'm just like, fuck off. If they go to Iman, then there's a chance they could come on. So I think that's a good example of...
Don't flood my DMs, please. We have enough inflow right now. We have enough inbound inflow.
Today we are discussing 7 rules for an anti-fragile portfolio and life, you can say, in a sense, which is on the Seeking Alpha website, linked in the show notes. We're going to be throwing up a few things on the screen as we go along. This, of course, much of it is based on the whole Taleb philosophy, or way of living life and managing one's finances and investments. As you listen to our pod, I guess you're following our evolution of what we're really fucking with at the moment. Like, of course, I came across Taleb a few years ago, but I kind of not disregarded it. But as you get older and you experience different things in life, it becomes more applicable to your day-to-day life and what you're going through. You may disagree with this based on the discussion we had recently, but for me, there is, in the sciences and mathematical fields and the STEMs, there is only one truth, whether we've found that yet or not in some areas of STEM. But Taleb solely touches on all the ideas of rationality, and most of it is mathematical and statistics and probability. So these are really heuristics, or what I like to use as risk management for life. Rather than optimize for the extreme upside like Silicon Valley, we're actually being very rationalist like Taleb and Munger, and saying, let's protect the downside first, and let's manage the risk, and then the upside will take care of itself eventually. So
the older you get, the more complexity you need to deal with in everything in life, I suppose.
You're telling me.
Exactly. And whatever doesn't appear complex on the outside often is complex. And as you go through this, like, a lot of it comes from specialization as well. So as you go through this period of specialization in whatever it is that you're doing, you're going further down a professional or non-professional rabbit hole in life, complexity increases, which means you kind of need to think about things in a less complex way, which is why I think Taleb's work often strikes a chord, because it uses really complex mathematical concepts, or statistical concepts, maybe I should say, to explain really simple things that you know to be true, but you don't know why that thing is true. For example, his Lindy concept, or a lot of the things he talks about, trial and error being suboptimal. And I think the reason why this Seeking Alpha overview of the 7 rules for an anti-fragile portfolio is interesting is because it takes a lot of the common things we know to be true around investing, but then it applies this Talebian statistical lens over it to prove to you that the complexity that sits behind these simple frameworks supports, in a mathematical or statistical way, the reason why you should do it. And I really like the way it's been written and the article itself, because there is very simple, it's written in a really simple way, and it also gives very actionable things that you can do as an investor, particularly for the public markets. Now, maybe we can talk about private markets separately in our angel investing. Often what you'll find is that the same concepts apply, because you're still thinking about the upside and downside elements of investing in a portfolio. That's maybe a bit of background on the thing itself. It takes quotes from Taleb's books and Taleb's research. So there's a lot of Taleb research that's gone into writing up these 7 different rules. And one of them is called Understanding is a Poor Substitute for Convexity, from the Antifragility scope of work that he had. And I'd highly recommend reading that. Taleb is quite difficult to understand sometimes, but if you read him 2 or 3 times, you'll probably pick up on a lot of his points.
It also covers this summary section. It covers ideas around optionality. So as you said, optionality is the property of asymmetric upside, preferably unlimited, with correspondingly limited downside, preferably tiny. So the reason I just want to cover a couple of these things before we go in, because we're going to be throwing around a lot of these terms, and people will think, you may think, what the hell are you talking about? So just to provide more context, we'll throw this up on the screen as well before I explain more. Convex describes shapes that curve outward like an American football or rugby ball. A curve that bends the other way is concave, as illustrated in the graph below. A convex payoff offers a significant asymmetry between the potential gains, unlimited, and the losses, limited. So what springs to mind here is, let's say, a VC or an angel investor who puts, I'll give an angel investment example. Was it Jason Calacanis, when he was a scout for Sequoia? He sourced the Uber deal, and I believe it was I may be wrong, but it was something like a 25 grand check in Uber. So they gave a part of the allocation for it to be owned by him, and the rest was Sequoia's. But anyway, 25 grand check went into Uber, and only God knows what that turned into. I think billions or something, or hundreds of millions 10 years later when it IPO'd. So what was the downside there? The downside was, for Sequoia, tiny. It's 25 grand for them. It's not a drop in the ocean. But the upside was unlimited. That basically made that fund over several times, so it made up for all the other losses. These are a lot of the ideas. I like to reference Daniel Vassallo a lot. His Twitter you should definitely check out. It's a goldmine. We'll link it here at the Vassallo on the screen. And he's basically like a mentee, you could say, or he's taken on all of Taleb's ideas, but with a modern twist, because he was a software engineer, and he's kind of like in the tech Twitter. He's at that intersection of tech Twitter and Taleb Twitter, and he's in the Fat Tony's community and does all these awesome stuff. But he talks about a portfolio of small bets, this term I keep throwing around in the last few episodes, because like he fired a shot at Sam Altman, and anyone that knows Sam Altman, I think he's absolutely phenomenal. One of the brightest minds probably in the world in Silicon Valley. Previously, he's only 36, and at 36 what he's accomplished is just insane. Like, he's exited companies. He was a partner he ran Y Combinator after Paul Graham stepped down. He's now running AI companies and everything. So extremely bright mind. But Daniel Vassallo is obviously the rationalist, and he takes on an approach of, look, we're not all necessarily maybe born into he doesn't even say this is more my view, but we're not all necessarily born into middle class US or whatever. Some of us may be immigrants, some of us may have, just forget the immigrants, we may have different preferences in life. And so Sam Altman posted this tweet we'll pull up, which said, when I want to make an investment, I ask these questions. What does it take for you to become $100 billion company, or something like that? And then Daniel Vassallo fired back with like, this is how to guarantee you'll live the ramen lifestyle on ramen noodles for like 10 years and still probably not make it. Because statistically, as yes, Taleb does say skin in the game. He does tell young people, go start a business, don't work in large corporations. But he doesn't elaborate on this, because if you take all of the other Taleb ideas around risk, which is what Daniel Vassallo does, and he applies it to startups, he says this is stupid. He says, what you should really be doing is similar to what he's doing, is having a portfolio of small bets. So for example, he'll film a course that he puts on Gumroad, and the course will only be like, I don't know, a video course of like $25. So very, very cheap for people to buy. He's not like flogging courses out here, but he'll create a course. It'll take him 2 hours to film. And then he says the upside is either makes a lot of sales, which it has. It's made him like over $500,000 in sales, something that took him 2 hours to film. And the downside for him was, if it goes nowhere, I've lost 2 hours of my time. That's it. Rather than commit your life day and night to this startup, as we've seen many of our friends go through, many of the people in the industry go through, all this shit you see on tech Twitter, you see online on LinkedIn, all these fundraising announcements, all these bullshit announcements. This is survivorship bias. This is like one of the 1,000 that made it. You do not hear. And one thing that needs to be sort of not glamorized, but should get a lot more coverage, is the failures, which obviously no one wants to talk about. It's obviously people protecting their egos, trying to save face or whatever. But more often than not, this whole cliche of, 90% of startups fail. I actually think it's more than 90%, maybe a little bit more, but it's in that region. And there's some truth to that. It's not to say we're fucking pessimists. It's talking about, it's more so the rational optimist approach. And so Daniel Vassallo has this whole idea, and a few others do as well, which is very rational, is, look, have a bunch of small bets. So like, for example, you could earn income from your job as a software engineer, where you're working 6-7 hours a day. You have the rest of the whole day to work on all these side projects. Throw a lot of darts. He says, literally be a VC for your own life. So you, as VCs, make many investments. He says, do a lot of tiny bets or side projects in your life. He says most of them will fail. Some of them will take off. The one or two that really take off that you enjoy, double down on that. And then that has a high chance of turning into a startup that works, or a bootstrapped company or whatever. Some people disagree with me. The Silicon Valley has this whole fucking notion of, NGMI, not going to make it. Have fun staying poor. Like, fuck you. I really fuck with this whole Vassallo approach of it's and this is as someone who's had skin in the game in like the last few years, been in business and stuff, and had downs and had ups and all of this shit. I completely stand by everything that he preaches. Anyway, before we go into the rules, and finally before I wrap up this whole, it's been a very long intro or summary, and it says, by nature, convex things benefit from uncertainty, while concave things are hurt by it. Taleb argues that in a world where predictions are mostly useless, we want to make convex bets. Optionality can take many forms in our personal lives, such as avoiding debt, keeping cash aside, learning a new skill, hint, hint, Cal Newport, rare and valuable skills, machine learning, software engineering, UX, UI, SEO, whatever you want to learn rare and valuable skills, meeting new people. So Vassallo talks about how he'll put out, 200 tweets, and only 2 or 3 of them lead to the majority of his followers. Same thing. Then you meet a lot of people, and maybe 2 or 3 of them will be useful for you, but you have to do it. You live in a large city, and you start a low-cost side hustle. Wow, surprise, surprise. All of this is actually pretty much Vassallo's philosophy. So we've tapped into this little niche nerd corner of the internet, which is very much our philosophy. And it says only someone with optionality has the opportunity to experience trial and error repeatedly without hurting their current prospects. If you start with the premise that we are living in an uncertain world, then seeking optionality is an excellent way to generate alpha in the long run. Optionality is what can lead a profile to be antifragile, and this is what would thrive in a volatile and uncertain environment, yada, 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 yada. And the final thing I'd like to say, as I've said once before, is optionality in life is bad generally. So in the sense that what I've just covered, optionality is what you should be seeking. It's fantastic. But in certain areas of life, optionality is bad. So, moral hazards such as gambling, having, multiple partners, having just all the shit which is common sense that you shouldn't be doing, like drinking, drugs, or like going to McKinsey, then Harvard MBA because you want to keep your career options open and you want to have like 20 different career paths in your 30s. Like, this is not good. But optionality in your investments or side projects or skills on the side of your day job, these are all like crucial things. And I don't know if that makes sense, because that part confuses some people.
Interesting thing about optionality in general is that it can be overcomplicated. So, and what I mean by that is people can overcomplicate what optionality means. And in the context of what we're talking about, I think it's pretty simple where optionality should sit in the way that you try to make money, in the way that you apply your investment strategy to whatever portfolio it is that you have, be it private or public. And I think the only point that's being made here is that try to make bets, and bets is an important word, I'll come to it in a second. Try to make bets that have the potential for unlimited upside without the risk of ruin. That's all that's meant by optionality. I think that optionality gets confused with optionality that exists in your life, which is separate. And I think from a mathematical, statistical, whatever perspective, I think that's what we're trying to talk about. And the first rule, the first point that is picked up in this article.
Sorry.
Go.
The last thing on that, because there's a very relevant Naval tweet from a while back where he says asymmetric opportunities, and he says these are the points: invest in startups, start a company or side project in what we're recommending, create a book, podcast or video, create a software product, go on many first dates, go to a cocktail party, read a Lindy book, move to a big city, buy Bitcoin, and tweet.
He's talking about asymmetric upside, the same thing as optionality, which is basically it's increasing your optionality with the risk of ruin being low. The first rule that they talk about, which is probably the most important rule and picks up on a lot of what we've spoken about, is seek low downside, high upside payoffs. Seek low downside, high upside payoffs. Basically, what we're talking about here is the split between risk of ruin and outsized outcomes, outsized returns. You want to be betting on stuff where you know that there is a potential for extreme growth. To know what that means around, where that potential can come from, there are multiple ways of thinking about that we'll come on to in the other rules. But the key concept that you want to be batting for, that you want to be getting right, is that you want to ensure that whatever your portfolio is built up around means you don't lose money or a significant amount of money that's going to cause you to be homeless or not have food to put on the table or not be able to support your children or whatever, but that the upside outweighs anything that you could do regardless. Now, in a private market, when we're angel investing and you're spreading bets, what you try to do is put really small checks. This is to your point around the Salo portfolio of small bets. Put small checks in because you're betting on very high growth companies. These high growth companies have a multitude of reasons why they could go to shit. There are some reasons why they could blow. If you catch enough of these fish, if you fish enough and you catch a fish that's about to grow at a rapid pace, you're ensuring yourself that the upside is something that you can take advantage of. Taleb says specifically, this is a bit of a long quote, but he says, if significant risk exists in a single transaction, overall risk should be reduced by making that purchase one of many mutually independent commitments. Thus, you may consciously purchase a risky investment, one that indeed has significant possibility of causing loss or injury, if you believe that your gain weighted for probabilities considerably exceeds your loss, comparably weighted, and if you can commit to a number of similar but unrelated opportunities. Most venture capitalists employ this strategy. What is he saying? He's saying that sometimes taking the risk with a potentially higher downside, but with an extremely convex upside, can be worth it. And he talks about VC specifically. VC is literally the epitome of the convex bet, and ensuring that you're trying to bet on as many potential high upside businesses such that the return on your capital will ensure your ability to return your fund. And Peter Thiel also talks about this. So when he, I think, set up Founders Fund, he was talking about every single one of my investments has to have the potential to have such a convex return that I can return the entire fund. If my LPs have put in $1 billion, I should be able to return $1 billion for every single transaction that I make in terms of an investment.
And this goes back to why Sam Altman was saying in that tweet, my question is, well, how will your startup become a $100 billion idea? Fair play. I mean, it's his job. Like, he has to do that. And it's not to say that no one should be doing startups that are that ambitious. I think actually there should be more. But the issue is, and what Vassallo gets at is, okay, it's all about risk management in life. If you are, I always reference this tweet, this girl who once said millennials or Gen Zs say they want to follow their purpose, but then they end up working as FANG product managers. And then I hit back with, yes, but many are immigrants with lack of stability or PTSD from the lack of stability growing up. And for them, it's more important to take care of family and whatever. And then eventually maybe they'll follow purpose. Not all are privileged for purpose or something like that. Vassallo is using a more risk management approach. So, he left Malta and he's essentially an immigrant and he's got a wife, kids. So it's about managing your risks and also your preferences for life. If you are in a position to be able to take risk, I think you should, but it's still not to disregard all of these. So even within a company itself, a company will experiment many different things. So Amazon itself, we've said this before, will try 100 different, they're known for this, why they've been so successful. Bezos would experiment at any given time like 100 different things, and only 2 of them or 3 of them would take off. For example, AWS, Prime, whereas the other like 97 or 98 of them just fell, and these are things you've still never heard about. If you read some of the annual letters or you read some of, I think, the book about Amazon, you'll find out more about these failed experiments, but it's the same thing. So if you're in a position to take a risk and do a startup, go ahead and do it if you're trying to build $100 billion company or whatever. But yeah, like most people, let's be honest, most, especially like if you're an immigrant, you might not be in that position. And we know people, no names mentioned, who are around our age and they've literally been swinging for the last 10 years and still not made it and have had multiple failures. And you can see it's unfortunate, but the second order effects, the third order effects, whatever, it starts to take a toll on like who they are as a person. Like as Naval says, a person who's stressed, their judgment and decision making like deteriorates. Things start to slip through the cracks, like unethical decisions and things that they wouldn't have done before, like try to cut corners, or you can just see like they're not the same person they used to be. They start to lack confidence, lacking self-awareness, not really growing as a person because you're always trying to like everything's going to shit and you're trying to fix everything around you rather than let me just fucking take care of myself for at least 2-3 years. In a nutshell, I don't blame Altman and Peter Thiel and all these VCs, it's their job, but the same way they throw 100 darts and they expect each one to make huge returns, but for them it has almost no downside. It's just a bit of money, which whatever, it's LP funding that they can lose because one of the 2 of the investments will eventually take off. The same way they do that, you as an ambitious person or a rational optimist should say, I'm going to also have a portfolio of small bets. I'm also going to be a VC of my own ideas. And some disagree. Some say, no, you should be focused on the mission, on the what's the mission of the company. You'll focus on the one thing and your customers. Yes, you should be focusing on customers, but you should, while listening to them, you should be experimenting with almost everything that they're recommending that makes logical sense to you. And just be a VC of your own ideas. Throw lots of darts. 1, 2, or 3 of them will take off and double down on those. And eventually when that takes off, then yeah, you can quit your job and depend on your company because then you've raised VC funding. So we're not saying don't go down this route of whatever. We're kind of trying to find a balance between the approach of don't be as stupid as go into this and delusional as I'm going to build $100 billion company. Like, good luck, but statistically speaking, it's probably not going to happen no matter how good you are. We've seen some of the best founders unable to do this, and to be honest, some pretty mediocre founders actually take off in life and do really well because so many variables are out of your control. This is the whole fault by randomness concept that Taleb explains. There's so many variables out of your control, and Morgan Housel talks about this confusing luck with skill. And it's so interesting because there's this chart or whatever where they did this survey where they ask people around our age, like, how much of your career would you say is down to your skill versus your luck? People around our age who are doing well in their careers, a high number of them, like large percentage, like it's mostly down to my skill. Like, I think, I've been working really hard, I'm talented, all this bullshit. And then you ask someone who's like in their 60s, like even someone like Doug Leone, he's like, it's mostly luck. So of course we all work hard, but some variables, some things went in my favor, like right place, right time, did this, did that, and things out of my control. Like a lot of it is luck. And the best of the best all acknowledge that, so much of their success is down to luck. So it's being aware of all of these while trying to manage the risk, while being ambitious and a rational optimist. You're trying to balance a lot here. But in a nutshell, I think these 7 rules, especially this first one I've just touched on, of being a VC of your own ideas, low downside, potentially high upside, is a good way to go.
If you're new to the pod, you'll get used to Cyrus saying in a nutshell and then speaking for 8 minutes. So welcome to rationalvc.com. To actually put it in a nutshell, there are 3 things that come out on the basis of this. The first is You have to have a large number of bets that often need to be uncorrelated, i.e. not related to each other. The second thing is you're looking for tremendous growth potential. You want to go away from the Munger and Buffett way of thinking about stock picking, which is, am I getting this stock at a bargain? And I'll explain why that's important in a second. The third thing you want is a long-term horizon. I think a lot of what Cyrus was just talking about is the fundamental point of you need to think long-termist. Now, on the basis of those three things, everyone will always ask, and everyone always does ask, well, how do you know what growth potential looks like? What is tremendous growth potential? And if you're buying public stock market stocks, there are a bunch of things that you can think about that enable you to step away from the luck element and maybe make it, shift the scale slightly towards the skill point. Don't listen to narratives. Now, in the post-COVID meme stock era, a lot of stock picking or a lot of money making has come from following narratives because there's been enough strength in numbers to be able to move markets. However, non-narrative stock picking should be what you should think about in a long-term sense, which was the third point I raised earlier. What are some of these things? Well, just look for a company that's either growing its market share, has got positive cash flows, it's got an ability to grow into a growing addressable market. So the addressable market doesn't stay static, it grows over time. Look at the balance sheet, look how much cash is on their balance sheet, look at how they've performed historically versus the competition in the market, particularly if that competition is at a similar place to where this competitor is. And then look at the financials, look at revenue generation. Is it actually making money? What's its profitability like? If you just stick to these core principles that, by the way, Munger and Buffett do stick to in their value investing approach, that tips you a little bit more into the skill element, which allows you to then look at, okay, how can I make money that is targeted towards maybe the more growth opportunities as opposed to the value opportunities. This is so overlooked when people are trying to get stocks or invest in businesses. In venture capital, when we're investing, like when we're angel investing, often what we hear is, if Andreessen Horowitz or Sequoia or these really hot angels are invested in this deal, just invest in it. But what we've seen is with companies like Fast and that Australian Dom guy is, if you end up doing that, the whole point of VC, like we spoke about earlier, is just to take loads of bets. It means diligence, therefore, by design, diligence is limited, especially when you're investing early stage. And so you don't know a lot of the time whether the growth opportunity is there or not. You're just spreading your bets. And if you're an angel investor that makes maybe one investment a month or one every 6 months, and you're just jumping on the hype wagon because other investors have invested that you think know what they're doing. No, apply these growth principles, apply these diligence principles to how you think about investing before you go and put some money away. And of course, that money needs to be really low in comparison, such that you're taking advantage of that convex element that Taleb talks about. But still, don't just piss money away just because someone else has invested. I think that's an important caveat that we need to make when we're talking about antifragility.
Yeah, also I'd say like public markets generally, I wouldn't even look at it in the sense of how we're discussing things today, because recently Morgan Housel was on Jim O'Shaughnessy's podcast, Infinite Loops, which is one of my favorite pods. Morgan Housel said, like in Psychology of Money, the readers were most disappointed with the fact that he goes through this whole book, and then at the end he basically in a kind of recommends that what you should be doing is just putting your money into the S&P 500 or an index fund and just doing that for your life and letting it compound. And this disappointed people. But like public markets, that is really, we've discussed, again, you go back to risk management, and statistically speaking, that is the best way to invest. You will beat most hedge funds just by doing that. This problem is people don't have patience, and that I look very differently to. That's the whole barbell strategy of, for us, the 90% side of the barbell, the conservative side. Yeah, for other people it might be treasury bills or whatever, but in today's day and age with inflation, just to stay afloat, you need to be making 8%, which is usually the S&P's return. And so we look at S&P as the 90% side of the barbell. The other 10% side, which is the angel investing, is just throwing a bunch of darts, to be honest, asymmetric opportunities and everything we're discussing today. So I would not even try to pick stocks in the public markets. I would just keep putting it into the S&P 500. Don't even time the market. As Nick Majuli says, if you try to wait for the dip, it's been proven. You can go and read his stuff. It's been proven that that's the stupidest thing you can do. It actually leads to suboptimal long-term returns. The weighted average cost is lower if you're actually putting in consistently every month, forever really. So S&P 500 or an index fund or something that makes sense. The other side of the barbell is, yes, everything that you've been explaining, we've been discussing in terms of low downside or potentially high upside. And even angel investing. Look, a lot of people who listen to this, they might work in tech or finance, whatever. And if you're taxed on your salary and then you have to pay rent, bills, food, all of this shit, you're left with probably not that much if you're trying to live in a big city, as Naval says, and go on a lot of first dates or whatever he says, and you're buying Bitcoin. If you listen to all of his recommendations, like you're doing all of this and almost going broke. But no, seriously, like if you're doing even just whatever a normal tech or finance bro or woman or nerd does, if you're doing any of these things, okay, then you might be left with, who knows, 20, 30 grand. You're like, shit, if I do barbell strategy, then that means 90% of that. That means I can only put 3 grand a year into angel investing. So, okay, people who are younger can maybe take a bit more risk. They might do the 80-20 rule or whatever. But even then, you put 1K checks into like 10 companies, or 1K checks into like 6 companies or 8 companies. And so you got to get started somehow. And this is what my angel investing essay was getting at, which is like the big hitters, like even Shervin Pishavar was like, when I started, it was just 5K and 10K checks, and I kept doubling down. Some of them kept bringing in returns, and then I used the returns from those to make even more investments. And as Sriram Krishnan says, I wouldn't look at angel investing as something necessarily you have to put a large amount in or make huge returns. It's something that more is to create optionality for later on in life. And what he means by that optionality is the way this industry works, the social proof elements, the elements of people are like, oh, you invest, it just creates so many contacts for you, a network, contacts, relationships, which is essentially what this whole industry is based on, which is people are trying to monetize this in a sense now by giving access to these relationships, a la AngelList, Odin, Vauban, whatever. They're trying to leverage these relationships they've built to put it on a platform and for other people to have access to. So it is a relationship driven industry. So read my essay anyway, even though I've plugged it 50 million times, but that summarizes that very well. Anyway, do you want to move on to the next point?
Yeah, there's one which is interesting, which is be flexible and bottom up. So recently, this isn't in the article by the way, but recently Bill Ackman, who is like a really good money manager, right? He's quite a famous money manager, runs Pershing Square, I think. Bill Ackman whittled down, I don't know if he removed 100%, but I think he took out his position from Netflix. Netflix, if you don't know, had essentially a really poor quarter result because they lost, for the first time ever, they lost subscribers.
I think Ackman lost like 450 million or something ridiculous.
Yeah, but instead of like doubling down and being like, no, and he writes this in his letter to all of his investors, instead of doubling down and saying, you know what, I really believe in management, which he does, I really believe in the product, which he kind of does, he said, I'm going to completely pull out of Netflix because I'm not so certain anymore as to whether the return profile that we originally wanted to get in on made sense. And then he goes back to a specific point around his investment thesis and his methodology, which is if something ceases to make sense, if the logic that I use to invest in something in the first instance begins to waver or changes in light of new information, I am no longer scared to pull the rug immediately. And I think that is so important because what it's telling us is if shit stops performing, if stuff is not making you money anymore, don't be scared to just pull that money out and reallocate it. There's an opportunity cost of capital in that money that you've put into that specific stock. If it's the public markets, walk away from something if it's an angel investment. But the key thing is that you're able to distinguish between what is working and what isn't working. Taleb has a quote where he says, mathematically, 5 sequential 1-year options are vastly more valuable than a single 5-year option, which he's talking about essentially spreading your bets. But what's key in that is often if you know that something is not going to work in a post-rational way, so you realize it after the fact, don't be scared to change your mind and therefore do something differently. It also means don't be dogmatic around certain investments that you make. Don't make emotional investments. Don't bet on a religion, even though Munger talks about that in a different light. But it also means do be dogmatic around some of the principles that you have that enabled you to make that decision in the first place. Have a framework, have a principled way of thinking that enables you to make those right decisions.
Big facts. Especially, you know, it's funny, you just touched on ideologies and religion, a can of worms we will not open, but something that, you know, I've been very much studying the past year, and you go around a full circle, and it's funny because you always come back to the same conclusion as almost in a sense of what you had initially, but with a fuller understanding of why people do the things they do and stuff like that. Also, this whole thing of what you just touched on options. Earlier I said you really apply this stuff to public markets. Of course you can. Taleb made his money by doing options in the public markets, but he was a full-time trader for 20 years. And you probably have a job in tech or doing some other function in finance, and you don't have the time to be a full-time trader like Taleb and do all this options bets in the markets and stuff, and it can get messy, which is why I said for public markets just do S&P, but then for your other side of the barbell where you throw darts, asymmetric opportunities, you can do angel investing, crypto, whatever. This whole thing of knowing when to cut your losses, which is what you're touching on, if one is following the strategy of just weighted average cost monthly, putting in money into the S&P 500 or an index fund, and the bit of money that's left for speculation or having fun or asymmetric opportunities like angel investing, if you are following the strategy, technically you never will sell, and you technically cannot sell anyway, because your chunk of your funds are going into the index fund, which is almost stupid for you to pull that. It's idiotic for you. It goes against all the principles for you to ever pull that out, because the whole notion of compounding gets disrupted. Put your money into the S&P because you never pull it out anyway. And angel investing, you can also never really pull your money out. Of course, there's secondaries, whatever, but for your tiny little check, there's not going to be any secondary shares. You put your money in and you cross your fingers for 10 to 20 years. So I agree with all of what you're saying, but if one is following these strategies anyway, then they kind of get ruled out. If they're following this tech bro optimized strategy of a barbell strategy of what we've discussed, you kind of never have the urge to sell anyway, because you cannot technically do it.
The last point maybe that we should pick up on is something that we started with, which is a combination of two of them, number 6 and number 7 in the list. Number 6 in the list is Simple is Beautiful. That's literally the title, Simple is Beautiful. And number 7 on the list, do more of what works and less of what doesn't.
Woo!
On Simple is Beautiful, don't complexify, I think is the right word. Don't try to overcomplicate things. Literally don't do the optimized meme. Don't do the, what's it called? What's that meme called?
Midwit.
Don't do the midwit meme. Don't literally do what every tech Twitter bro does. I just fucking invested what the majority are investing in. FANG stocks, for example, everyone ended up getting into them, and everyone thought they were late to get into them, unless you were, Jeff Bezos, who invested an angel round in Google. Jeff Bezos thought he was late when he got into Google, by the way. So just Simple is Beautiful. Don't try to overcomplicate, and don't try to do things like leverage or overcomplicating the actual trades you are doing as well. It's great to have conviction, but don't go overboard. And then do more of what works and less of what doesn't. Goes back to this simplicity point. If your portfolio is doing well, and often it's quite difficult to tell as to whether that is because the market's buoyant or because you're making the right decisions, doesn't really matter. But if you're doing well, just keep doing what you've been doing that helps you do well. Don't try to then go and do something way overly complex. Don't look at the price of wheat, for example, post Russia's invasion of Ukraine, and be like, you know what, I'm going to beat this market and I'm going to lever 100x and buy some wheat because I know the price of wheat's going to go up. But actually what happened is it went up and then it suddenly dropped again. Like, you're going to put yourself in a lot of shit. Don't overcomplicate things. Just do what works for you. And often in angel investing, for example, what works is just getting to know the right people, putting yourself out there, talking to these businesses, understanding the underlying growth opportunities of these businesses, and putting small checks in. That works. Don't go overboard and try to be the next Jason Calacanis. Just do the little things and try to build up from that.
But I want a yacht and a Richard Mille. How dare you crush my dreams? All this rational talk is just BS. It's just a front. It's all about yachts, Richard Milles, and private membership Mayfair clubs.
You'd fit really well on the All In pod with Chamath.
Anyway, I love these points because it also touches on, of course, Munger, the classic quote on mistakes, which says, most of Berkshire's success grew from stupidity and failure that we learned from. I hope that makes you feel better about your own life. What you're touching on in terms of do more of what works and less of what doesn't. Based on anyone who's angel investing who's probably been working in an industry for a few years, let's say you Your expertise is EVs, electric vehicles, IoT, the connected home, climate tech, yada yada. The natural thing for you to do in terms of more of what works is when deal flow comes in for us, or you're looking at deal flow, you look at a company you're an angel investor in, and you're like, I actually understand this stuff. This is stuff I've covered a lot in my day to day. I understand what they're building, and I'm very bullish on this. And it's an asymmetric opportunity. It's more likely that I'll lose the money, but I really like this, what they're doing, because I understand it. And so that's the right way of angel investing. And even we struggle with this because the FOMO, herd mentality, yada yada of, A16Z and Sequoia are in this round, therefore we should be also putting in a tiny check. And normally what you find, if you ever go on AngelList where it has like angel investors portfolios, like Samir Kaji is one example who we've had on the pod, GOATs, Elite. When we interviewed him, we actually brought this point out. We're like, Samir, you have in your AngelList portfolio, you have 27 investments, 7 of them have exited. Statistically, that's like much better than the rest of the industry. How? Why? And like most of the companies are unknown. We've never heard of them because obviously we're on tech Twitter. We only know the herd companies. We only know like what everyone else, every other bro knows. And because he keeps his ear to the streets, he invests either in what he understands or in what his very, very close trusted contacts understand. And these are all like, let's say, the low-key people who are not screaming necessarily on Twitter. Like, we're in this bubble. This is why I haven't used Twitter in a few weeks now. I like to take regular breaks, but like when we're in this bubble, we don't realize that we are the 0.0001% representation of this whole tech investment ecosystem. And so doing more of what works, which is even what we have to remind ourselves all the time to do, which is more of what works is what we actually understand. Like Charlie Munger's, one of his main rules for investing, one of his 4 main rules is you stick within your circle of competence. If we're talking about asymmetric opportunities, so you're like, well, why would you have to stick within your circle of competence? It's asymmetric. But no, if within your asymmetric opportunities, all of those are sticking within your circle of competence, then statistically, it will probably improve your chances at least somewhat. Yes, we are whores for the industry too. We like to have a couple of hot names on our Rational.fund website. We like this shit too, but try and suppress that. If you do a couple of those, 2 or 3 of those hot investments, the rest of them, please, like we don't have to all do that. We can stick within circle of competence and seek out companies that we understand, potentially with moats. Most importantly, the team, good management team, and the talent you're betting on. You cross your fingers. If it goes to shit, who cares? Because the rest of your barbell, the 80 or 90%, has gone into the S&P 500. Keep it simple, bitches.
I think that's a good place to stop.
It is. And then at the end of the essay, it says bottom line. So, because the way we talk, we kind of go all over the place. But to bring it all back, it says bottom line. We've skipped a couple of these as well. Maybe ones that are more relevant to professional, full-time public market investors. It's not relevant to this podcast. But I'll summarize the 7 points. Bottom line, the key to making your portfolio anti-fragile, or your life really, is to improve your odds of success. To do so, you want to increase your portfolio's optionality. The rules are simple. 1, accepting that your luck matters more than your talents. Wow. Number 2, limiting your initial investment to a maximum amount.
Wow.
Number 3, much wow. Number 3, focusing on investments with large upside potential. Number 4, looking for simple, obvious ideas. Number 5, adding to winners. Number 6, selling losers, so cutting losses. And number 7, one of Rational's, values, long-termism, which is being patient. And it says here, with an anti-fragile portfolio, a black swan, a rare adverse event, will create tremendous gains for your portfolio instead of irreparable losses. Building an anti-fragile portfolio is simple, but not easy. It requires recognizing the limits of your skills and focusing on the odds by being diversified and taking a long-term view, which is what we've applied today to the tech bro version of angel investing, and while having a safety net in the index funds on the side. I think we 100% will bring Daniel Vassallo. I hope he'll come on, but I'm confident he will because we have some mutual contacts. I want to bring him on the pod, but honestly, that'll be such a mammoth episode. It'll probably be late this year or something. He's similar to Eric Jorgensen, where he went on the pod and they said, how long do you have? He's like, I have all day. So Daniel Vassallo will be like a 3-hour chat. So and I want to discuss so much. But yeah, until then, we've got Luke Burgess coming on. Stay tuned. Got that booked in. got a few other things in the pipeline, but otherwise, as you know, we put out what we can until we have a bit more time later this year. Basically, after 3 years off Instagram, I reactivated. After a day, I was like, fuck, now I know why I deactivated. Let me deactivate again. But it says you cannot deactivate for 1 week when you've reactivated. And obviously, when you haven't been on there for 3 years, Iman knows the way I operate on Instagram. And, you know, I'm just a generally promotional kind of guy there. RationalVC.com, everywhere you go. And so I've just been pissing everyone off with just a fair amount of posts, which I've now, you know, it's calmed down the last few hours, and I'll be deactivating soon. All right, we'll end it there. RationalVC.com. Shab Shit.